Welcome to the Gold Newsletter Podcast, your bank of knowledge of investment, economics, and geopolitics. Go to goldnewsletter.com for our publications and archives.
This is the Gold Newsletter Podcast. Fergus Hodgson, your host. Thanks so much for tuning in. It is my honor to have today Daniel Lacalle on the show. If you want to get up archives to hear from him, Gold Newsletter Podcast goldnewsletter.com/podcast. Now, Daniel has been on the show before, but just a little bit of his bio. He's a PhD economist and a fund manager with the CIA financial analyst title, and he's the chief economist of Tressis SV. His latest book is Freedom or Equality, as you can see on the top there. And I've also reviewed his book, Life in the Financial Markets, so we'll put up a link to that in the show notes. Daniel, this is obviously an important time. I'm so glad we could speak with you.
Thank you so much. Thanks for inviting me. It's a pleasure.
My chief question to you is, this enormous correction we're observing, or enormous recession we're entering, how much of this is actually the result of the coronavirus, or was this just the straw that broke the camel's back?
I think it is part both. No, on one side, the reality is that the global economy was in evident slowdown in 2019. If you look at the fourth quarter GDP of Japan, it was -6%. The Eurozone was already in stagnation, and we had already seen severe and almost relentless reductions in estimates of GDP growth. So that was already something that was there. No, we cannot ignore the existing slowdown, and obviously the coronavirus epidemic and the decision from the major economies to shut down the entire productive capacity, or at least the vast majority of it. That is certainly something that, as you very well said, broke the camel's back.
Yeah, that's my concern, because a lot of us have been suggesting there was a need for a correction, and that ratios were so high, price to earnings ratios, for example, that there was a ripeness for a correction already. And I fear that is being clouded by this coronavirus and made much worse, of course. And I've been listening to a few of your videos. You put out these brief clips on your YouTube channel, so people can go there to follow your work. And one point you made, which I thought was very interesting, was the way that small businesses in general have around 2 months worth of cash on hand. So if this goes on longer than that, there will be permanent damage. Do you want to expand on that point?
Certainly. Actually, it's a lot less than 2 months. If you look at the vast majority of small and medium enterprises, not just in the United States, but globally, the typical restaurant, the typical shop, which comprise of the vast majority of the business fabric of most economies, and certainly of the services sector, which is 70% of the economy in the leading ones. These have between 25 to 57 days of cash at best. They run basically on the invoices that they generate on a monthly basis. So one of the big risks of this global shutdown, or at least of the majority of the shutdown that we're seeing in the leading economies, is that it affects directly the heart of the part of the economy that was actually growing in the two past years, 2018, 2019. The vast majority of the improvement in the economy of the Eurozone came from travel and leisure. In about 38 to 39% of the GDP growth came from that sector. So the decision to shut it down can have ripple effects on the economy, because on one side, these companies have very little cash to survive. On the other side, many of the governments are thinking about this as a parenthesis, as something that is just going to be a temporary shutdown. But the temporary shutdown affects two very significant parts of the small and medium enterprise fabric. First, the invoices that they had already sent for this month, they're not being paid. They're being delayed at best. No, so that is one important factor that leads to a build in working capital problems. The second one is that very few will doubt that anybody that's seeing us right now will doubt that once the economy is open again, it'll be very, very difficult for the average consumer to go back to the levels of consumption, of travel, of leisure, of use of holidays, etc., that we used to in the past, because of the unemployment that will remain in the economy, but also because of a change in consumption patterns. There's going to be a very dramatic change in the way in which consumers behave post the coronavirus epidemic.
Yeah, just that point there. How will consumers change their behavior post this virus, whenever that may be?
I think that anybody that's watching us right now is already doing it and understands that there will be a predominance for keeping savings to a maximum.
Right, sure.
There's also a logical decision to avoid traveling to countries for holidays, etc., when you might fear that there's a second wave or a lockdown that you're not expecting, that kind of thing. No, so there's a logical post-crisis type of, let's say, prudence in consumption.
There's a few things I want to say about that. One, I'm in an MBA program, and right now, almost all the internships are up in the air, right? So we're going into the summer, and normally we do a 3-month internship, which sets us up for a long-term position. And I don't know how many of those internships will go ahead, but my guess is the vast majority will not. So that is one example where the damage is permanent. All these people going through these programs right now will not enter the job ladder in the normal manner, and that will be a loss throughout their careers. Basically, who knows how that entry point will play out later on? I'm not sure. In terms of people being more prudent, is there any silver bullet here in some ways in that they will be devoting more of their money to valuable investments or using it more wisely rather than just short-term expenditures?
It's difficult to predict. If we look at the example of the post-crisis pattern of consumer behavior in Japan, consumers tend to be hoarding cash, or at least looking for any way to minimize the unnecessary expenditure. The reason is not because they're excessively prudent or because they are afraid, but because they understand that even if they're not economists, that the second wave of solutions post a crisis like this comes from erosion of purchasing power of currencies and salaries. So consumers are a lot less aggressive about what they decide to do with their money. Investment is interesting, no? If we look at also the pattern of what happened in Japan or what happened post-crisis in many countries, is that the average saver, the average small investor tends to be extremely scared about volatility and tends to be very much away from equity markets. You've seen, for example, that the holdings of equities of small investors have fallen dramatically crisis after crisis. And the average household, for example, in the United States, exposure to the stock market is very limited, even in the ones that have some exposure. No? So it is difficult to predict. What is very easy to predict, and I think that each and every one of us can understand from what we are thinking right now and what we are doing right now, is that what each of us are doing on a daily basis, which is to be more prudent, be less exposed to, let's say, discretionary spending and be more weary about volatility, those things are likely to be sort of widespread.
Yeah. Many of us, I'm including myself here, are concerned that this shutdown is just incredibly overzealous and you discussed these permanent effects. How does someone who wants to promote more restraint or even-handedness in response, how do you respond to the maybe what I would call hysteria, but let's just say widespread fears causing just almost an authoritarian shutdown? What's the alternative to that?
Well, the alternative to that is unfortunately very simple, and also unfortunately it seems to be like something that is rejected immediately by every interventionist government that sees this as an opportunity to increase the level of control of the economy. The answer lies in Singapore and in South Korea. These are extremely high levels of economic freedom economies with very little government spending and with very little levels of intervention, in which the government has done two things. One is to put at the forefront of policy prevention, testing, and giving protocols and equipment to companies so that companies themselves decide what are the courses of action in order to keep the economy as stable as possible, obviously without denying that there's going to be a slump. No? But it's absolutely critical that what these governments have done is to provide the protocols and the equipment so that companies themselves decide what is the best course of action to keep the supply chains maintained and safe. The second thing, obviously, is to, instead of shutting down the economy, is to keep very strong levels of testing and prevention measures from the healthcare authorities. These are two things that, interestingly enough, neither the most socialist governments in Latin America or things like that have decided to do, rather the opposite. You've seen, for example, how in Mexico the president decided to say that this was not a problem and that nobody should do anything about it.
Yeah, he said apparently Mexicans are immune, so yeah, sure.
Unbelievable. But it's unbelievable because what it's showing is that those that have sort of state intervention in a pedestal should be extremely worried about this environment, because it's the governments that have been more interventionist, the ones that have failed the most. Because these are the governments that decided to ignore all the health warnings from the World Health Organization, and second, afterwards have generated an absolutely monstrous level of economic crisis.
The Gold Newsletter podcast is proudly sponsored by the Discovery Group of Exploration and Development Companies. To learn more about our exceptional track record and exciting future, visit discoverygroup.ca.
Hi, this is Brian London with this week's Junior Mining CEO interview. And this week we have Steve Swatton, CEO of K2 Gold, with us. And K2 Gold, importantly, is a member of the Discovery Group, which, as all of our listeners know, is the group that sponsors our podcast, and a very credible group, brings a lot of credibility to the markets. Steve, great to have you with us this week. To kind of set up the story here, K2 Gold is a junior gold exploration company, and that's kind of an area that the Discovery Group has specialized in, some of the biggest successes in recent memory out there. Can you tell us how K2 Gold hopes to kind of carry on this tradition of success that's been prevalent in the Discovery Group?
Yes, Brian, thanks for having me on your show. This property in Eastern California was recognized by Chris Taylor and is being visited by John Robbins. These are two of the principals within the Discovery Group. The company was originated from the Yukon Territory, and we have a very good property up there. But the feeling was is that the Discovery Group have a certain amount of currency because of recent successes that you alluded to. We decided to go and look for something a little more advanced and with maybe a little bit more appeal. And particularly for me, I can work year round. We homed in on this property that Chris had worked on, Chris Taylor, back in 2013 with Great Bear. It's an oxide gold, being worked in the past by Newmont, by a BHP and a company called Asamera, discovered in 84. It was in a wilderness study area before. It was rescinded from the wilderness study area by Diane Feinstein in 94, and it was rescinded simply because it has mineral potential. We have gone in there subsequent to Silver Standard, were the last people in. And the main issue is that we're dealing with there is a certain amount of opposition, and we're not going to shy away from it. We know it's there, and it has been in the past. But we intend to build on the good work that Newmont and BHP have done and submit a drill program submittal by the end of May.
Now, Steve, it's important to know that you're in California, so the market applies a certain discount typically to projects in California, but there's good California for mining and there's bad California for mining, and you're definitely in the good part of California. And another thing I'd like to stress is, Chris Taylor is the driving force behind Great Bear Resources, which has to be the biggest success in exploration of the past couple of years and maybe of the last decade or so. For our readers in Gold Newsletter, they've enjoyed as much as a 26 times win in that stock. And can you share with us what Chris thinks of your Mojave property, which is what we're discussing right now?
Well, how it came about was last November, Chris and I were talking about best projects we'd ever saw. Chris said, well, I have worked on this one before, but it was when I was a Chris Nobody. And now Chris says, I just really don't have the bandwidth to take this property on. But here's the location. It's close to Nevada. It's in a desert-type environment, close to a small town called Lone Pine. Give it a crack. And so we went there. It took us almost a good part of a year to get the license. But Chris said the great thing about it is oxide gold mineralization at surface, maybe some Carlin-type affinities, but not convinced about that. We went in, and we've subsequently replicated some of the work that Chris did, looked at all of the different areas. But more than that, Brian, we've done some Landsat imagery studies, and also we've done a huge 1,000 soil sample plus program and 600 more rock samples. We know there's more zones than the previous guys looked at. Not that they probably didn't know they were there. It's just that we've done a more extensive program and proven that there's more than just 4 or 5 different locations of interest. But Chris is an advisor to our company, and he was the one who was pointing us in the right directions.
So just to set this up again, Chris, who's currently working with Great Bear on the Dixie property, which has the very realistic potential of eventually yielding tens of millions of ounces of gold and being one of the best discoveries in recent history, says that this Mojave project was the best project that he had ever seen, and that you've done some more work here, added to the previous work, even more so than when Chris was there. And I'd like to focus in on one area, the Newmont area, where drilling by BHP got some remarkable intersections starting at surface and a trench of 42 meters of over 4 grams per ton gold. That's an extraordinary trench. And it looks like you actually have drill permits for that area?
We do have drill permits currently in place. They are a helicopter-supported drill program that's been authorized by the BLM, the Bureau of Lands Management. And look, we're looking at all options here, Brian, on the table. Doing a heliborne survey is obviously more expensive than a road access one, but we've got it in our back pocket ready to go. We already know, we've already costed it out, and we will, if conditions dictate that it's worthwhile to do, we will actually execute that as soon as this current situation that we're all living under expires. But our main focus is maybe a 50 to 60 hole program, land access, using the BHP road that was driven in the mid-90s by BHP.
Well, I think that's the important thing, obviously. In exploration, drilling is the kind of news the market wants. And being a Discovery Group company, having that kind of provenance and credibility, and having the guy that has perhaps the biggest discovery story out there say this is really one of the most exciting projects he's ever seen, and being ready to drill and produce information to that kind of news flow to the market, seems like you're in a very good place. Can you give us just a brief summary, Steve, of how much money you have in the bank, and if you're actually ready to start drilling once we get past this COVID pandemic issue?
Yeah, we have approximately 1.8 million Canadian in the bank at the moment, and our burn rate is less than 50,000 a month. We are absolutely ready to go ahead. We've costed it out. That's basically what we've been doing as we sat in our various homes, spoken to the drilling company and the helicopter company, which we used on a visit recently. They are firefighters. We are ready to go on this heliborne, but we also have costed out a land access program, and we think it's somewhere between 2 and 3 million. So once we go ahead with that, you can imagine, Brian, if we get acceptance to do our drill permit, we'll have a re-rating in the K2 stock without a doubt, because it's probably the largest undeveloped exploration property in this part of Southwest U.S.
Yeah, it really looks exciting from my standpoint. And if anybody's looking, and I guess everybody is looking, for the next big discovery in junior gold exploration, then you want to look at something with some analogies to something like Great Bear, and you want to look for something that has the kind of credibility as the Discovery Group. So Steve, thank you so much for giving us this update on K2 Gold. That's the symbol is KTO on the TSX Venture. Great to be with you today, Steve. Thanks so much.
Thanks very much, Brian. It's been a pleasure.
It is something that feels unprecedented. Maybe I'm too young to know past depressions or whatever, but in my life, it's unprecedented. And this ties into one of your books. So I should mention, you've got 3 books, and one of them is from 2017, Escape from the Central Bank Trap. I just cannot process how much, let's say, activity or interventionism is going on from the central banks. And people are asking me all the time, will there be inflationary pressure? And my sense is no, but maybe you want to clarify that. So what will be the inflationary pressure? And is this changing the very role of central banks in modern economies?
Well, will there be inflationary pressures? Yes, there are inflationary pressures. And any American citizen that is watching us right now is seeing enormous inflationary pressures in non-replicable goods, in services, in healthcare, in rents, things like that. So there is inflationary pressure, obviously, in non-replicable goods and in financial assets. The fact that you have in today's world countries that are almost bankrupt and in the middle of a massive epidemic and economic crisis, financing themselves at negative rates, that is massive inflationary pressure. So there is inflationary pressure, but quantitative easing is not inflationary. It is monstrously disinflationary, because what it does is, first, we need to understand that quantitative easing is not the same as the process of money printing that Argentina or Venezuela undertakes, okay? Which is literally to print currency to pay for government spending, okay?
Right.
That creates inflation. What quantitative easing does is basically to leverage the economy. It is literally what central banks do is exactly what a commercial bank would do, but without a collateral that is an asset or a business. What the central bank does is that it generates credit to the economy. And by doing that, what it is doing is that it is perpetuating overcapacity, because if you have a business that is inefficient and that is not doing well, there's ample liquidity and massive credit and supply in order for you to refinance perpetually. Second, so it perpetuates overcapacity. Second, what it also does is that it completely depresses money velocity. So you put a lot of money into the economy, but the movement of that money in GDP is very slow. And third, obviously, it incentivizes the parts of the economy that don't generate inflation, that generate disinflation, because it monstrously benefits current spending by governments, which means that it's like what you're doing is literally you're bringing the net present value of future taxes today and spending it on current spending. That is disinflationary. You perpetuate overcapacity, incentivize debt, and reduce the money velocity.
Right, and is that also because when you spend money through government, these prices, if we can call them that, are inflexible? So it's not like when you spend in the private sector where the prices can change or fluctuate. Government activity.
No, it's the purchasing power of the currency. It's basically the reason why it's disinflationary is because, well, let's QE is disinflationary for the reserve currencies of the world, not for everybody else. QE is hugely inflationary for India and for other countries. Okay, why? So what the Eurozone or the US dollar economy, the North American economy, the United States are doing is literally absorbing the savings of the rest of the world. No? So it's disinflationary for those countries because the countries of the Eurozone and the country or Japan itself or the United States, what they're doing is exporting inflation elsewhere. You see what I mean? By you absorb the savings of the rest of the world, you maintain the overcapacity inside, and you export your excess inflation to the countries that actually are the ones that are saving to buy your bonds. It is literally stealing from future generations of emerging markets.
Well, I guess it's a luxury that the reserve currencies have, that they can export their inflation. Yeah, so it's a warning to other countries not to necessarily rely so heavily on the US dollar or on the euro.
You see it's a warning to other countries not to copy the ECB, the BOJ, or the Fed, believing that you can do the same without the demand for a currency that they have. The Bank of Japan knows that it's in brackets unlimited QE is limited by the massive amount of dollar savings that the economy of Japan brings into the country. That is, they're not stupid. No, the ECB knows that its unlimited QE is entirely dependent on the massive trade surplus that is holding the euro together. Okay, the United States knows that its unlimited QE is also dependent on the global demand for dollars. But if you're the central bank of India or Argentina or Brazil or any other, and you decide to do exactly the same, but without understanding that there is not only international demand for your currency, but domestic demand for your currency, then your dependence of the dollar is much higher. That's why there is such a huge shortage of dollars everywhere. Not just because the central banks are doing things improperly, but because domestic savers in those countries don't want local currency risk.
Right. There's a lot more we could get to, and we've raced through the half hour with you. Do you want to there's a lot more to say, and Daniel puts out a lot of content. So he has his books, and do you want to just briefly explain your latest book, which is it out just these last few months? When did Freedom or Equality come out, which is very timely, I guess, at this time? Yeah,
exactly. This is the book. It's called Freedom or Equality. It's out now. You can get it on Amazon and spend.
What motivated you to make maybe a transition from more straight economic work to maybe this is almost like classical liberal advocacy. How do you describe this latest edition?
Yeah, the reason why I wrote Freedom or Equality was because it was something that I was seeing, that there's this constant wave of doctrine that's coming relentlessly on the media about so many things that go against logic. And one of the things that I wanted to do was to put in a book together all those arguments that debunk the messages of interventionism, of more government spending, of more printing of money, etc., etc. So the book basically works if you're interested to have a healthy debate with all those people that say that inequality is soaring, that it's an absolute disaster, that what we need to do is to print money and give it to the people, and that what we need to do is to spend and spend and spend, and that the government is the solution for everything. What I tried to do was to create a book that would help anyone that wants to have a conversation with anybody that actually says those things and debunk it point by point. And at the same time, for those that actually do believe in all those magic solutions, also to tell them why they don't work. So that's the reason why I did it.
Okay, so Daniel's website is dlacalle.com and /en for the English version. Daniel, I appreciate your time. We look forward to having you on again in future.
Always a pleasure. Thank you so much for having me, and have a great day. Stay safe and wash your hands.
Cheers. Cheers.